We have now arrived at the last part of this investment series. We will now talk about mutual funds. What is a mutual fund? A mutual fund is wherein a company pulls money from many investors and invests the monies in securities such as stocks, bonds, and short-term debt. So to understand more about mutual funds, let us watch the following video.
A mutual fund is a collective investment that pulls together the money of a large number of investors to purchase a variety of securities, like stocks or bonds. When you purchase a share in a mutual fund, you have a small stake of all investments included in that fund. Think of a mutual fund like a basket of investments. When you purchase a share in a mutual fund, you are buying one share of this basket, and therefore have a stake in one small fraction of all the investments in that fund. Mutual funds can potentially benefit investors in several ways. They are a way to make a diversified investment. Most are managed by financial professionals, and because of the wide variety of mutual funds, they allow investors to participate in a wide variety of investment types. Let's walk through an example of how a mutual fund works. Suppose there's an investor who wants to invest some of his retirement portfolio in the stock market, but he doesn't have time to analyze individual stocks and create a diversified stock portfolio. Instead, he decides that he'd rather purchase a mutual fund. This way, the investor can purchase a single investment, which will be similar to purchasing an entire portfolio of stocks. But which mutual fund is right for him? To find the right one, he uses online tools such as mutual fund searches and ratings given by independent third-party organizations to find a mutual fund that meets his investing goals. Once he finds a fund that looks like a good fit, he reviews the fund's prospectus, which is the official summary and explanation of how the fund operates. The prospectus provides a variety of information about the fund, including its fees and charges, minimum investment amounts, performance history, risks, and other useful information. After researching the fund and its prospectus, our investor decides that this fund looks like a good investment. So, he buys the minimum required investment amount and purchases shares of the mutual fund. By owning shares, the investor now participates in the gains and losses of all companies held in the fund. A benefit of this is diversification, which is when an investment or portfolio is spread across several different investments. Doing this can help lower risk. For example, if one company that the fund invests in has a rough year, the impact on the fund's total assets can be small, because that struggling company is only one fraction of the fund's total assets. Like most other mutual funds, the fund the investor chose is actively managed, meaning it is run by a fund manager or managers who buy and sell the fund's assets. Fund managers aim to provide the biggest returns they can for investors by using financial analysis and professional expertise. While a talented manager could earn good returns for the investor's fund, there is no guarantee of success. If a manager makes choices that don't pay off, our investor won't earn the returns he was hoping for. However, even if the fund doesn't perform well, the manager still collects a fee, which is paid from fund assets, meaning even lower returns. Management fees aren't the only costs our investor has to pay either. Besides transaction fees, the fund may have a sales load, which is a charge to either buy or sell shares. Some funds also charge an additional load if shares are sold within a specific time frame. Now that the investor is bought into a fund, how might he make money from it? One way is through appreciation, which is when the fund's shares go up in value. Typically, when the fund's assets rise in value, the fund's shares do the same. Unlike a stock, the value of a fund's shares does not change throughout the trading day. Instead, the fund's value is calculated and updated when the market closes. Another way an investor might make money through a mutual fund is from a dividend payment, which is when a mutual fund pays out a portion of its earnings to shareholders. However, when the fund's assets fall in value, the fund's shares do the same, which is a risk of owning a mutual fund. One benefit to mutual funds is the variety of mutual funds available. Our investor chose a mutual fund that invested in stocks. However, there's a mutual fund for almost every type of investment. For example, equity funds buy stocks, fixed income funds buy bonds, and balanced funds buy both. Some mutual funds may invest in a whole index, while some others focus on stocks of a certain country or market sector. Certain funds have different objectives as well. Some may look for riskier stocks in growing industries, while others will invest in more stable companies. There's a lot to learn about mutual funds and other investment options, and we've got the resources to help you get started. Take a look at more of our award-winning investing education.
Okay, so what are NAVPS or NAVPU? So they stand for net asset value per share or net asset value per unit. So what does it represent? It represents the price of one share unit. Take note that this value, it changes every business day depending on the market performance of the bond. So for example, I have here a table. So this one, it's telling you the number of shares and the NAVPS as of September 7. Okay? So that means one share, one share costs 3.2503. And you have number of shares is 1,322, correct? So that's why this 426.90 is actually the product of 1,322 times 3.250. Is that clear? This is if meaning to say if you will redeem, you will sell, okay, you will only get 4,296.90. All right? All right, suppose on February 22, 2019, you invested 100,000 pesos and the NAVPS at that time was this 1,572.7125. How much is your money on February 4? So this is the NAVPS on February 24. How will we do this? First, we have to compute the number of shares that you were able to buy, right? So that's 100,000 divided by 1,572.7125. This is the number of shares. So that's approximately equal to 63.5844, right? But now the value of each share is 1,618. So we will multiply it with value per share. So 63.5844 times 1,618.1225 gives us 102,887.3483. Okay, so as you can see here, you gained 2,887.3483. You will not get that from investing in savings account. Now the current interest is 0.25%. So if you just invested your money on a regular savings account, you will only get 100,000 times 0.0025. So that's how much is that? This is 1, 2, 3, 4. You will only get 250 pesos as compared with almost 3,000. So it's like times, what's that? 4 times 3, 12 times from savings account. Alright? Alright, try this example. You can pause your video and try to answer the following. Okay, assuming that you have, excuse me, that you have already paused your video, let us now discuss the answer here. So again, first we want to know the number of shares that you were able to buy at the time you made the investment. So that's 500,000 over 312.01. What is that? 500,000 divided by 312.01. So you get 1,602.5127. Okay? But then when you decided to redeem, meaning to say you want to sell your share. So on when you want to sell it now, one share costs, what's that? 350.24. So you will now multiply this with 350.24. So you get approximately 5,661. Okay, so this is actually a good investment because you were able to get a profit of 61,264. So this fund is well managed by its fund manager. There are many kinds of mutual funds. The first one would be money market fund. What is this? It invests purely in short term, 1 year or less. Okay, so just like time deposits. The second one is equity fund. So it invests primarily in shares of stocks. You also have bond fund. Of course, it invests in long-term debt instruments of government or corporation. So this is actually lower risk than equity fund. And of course, you have a balance fund wherein it's like a combination of equity fund and bond fund. So it depends on the kind of mutual fund that you have. There are balanced funds wherein they invest 50% in equity and 50% in bonds. All right, so let's now take a look at some of the top performing mutual funds. So I'm now here at uitf.com.ph and it depends what kind. So for example, you want to look for the highest performing balance fund. So this is from year to date or if you want year on year. So let's say year up to this date. So the number one is, we have Robinson's Bank. It has an ROI of 5, I'm sorry, 5.5339%. And then you also have BPI. But then for the rest, they actually have negative return. Lugi. Okay, so what about equity funds? So filter. Let's look at the top. Okay, Manulife. Actually, maganda yung ano ni Manulife. BPI, it's negative. So this is actually um, this will give you an idea as to what kind of mutual fund you would like to invest. Actually, for me, I have BPI eh. So, pangit pala yung performance niya, no? Pero when I bought that, kasi I wasn't teaching GEM at W at that time. So actually, this is also a learning experience for me because I also learned a lot from this course. Okay, let's now look at the pros and cons of buying mutual funds. The first pro advantage is that you don't have to select a specific stock or bond fund because the balance fund will automatically choose the stock and bond investment. Wait, this is actually the pros and cons of getting balanced funds. But actually, this is also okay. This is also the same advantage for all kinds of mutual funds. The point here is that you don't have to check. For example, you took equity fund. So it's up to the fund manager whether they will what corporations they would like to invest to. Because remember, for equity fund, they buy um, corporate stocks, right? And it's also a good choice when you do not have any know-how really on how to invest. And of course, you're not ready to hire a financial advisor because the fund manager will do everything for you. Okay, you just have to buy. Okay, but of course, the cons is that the fees will be a little higher because you have someone else doing the work of selecting the funds for you. Of course, nothing is for free, right? So it's like this is your payment to the fund manager and the bank facilitating the buying of your mutual fund. Okay, capital income versus labor income. You can also think of it as this one here is passive income, and then this is active income because you have to work for your money. Now, the reason why people are rich, it's not because they work really hard. Okay, so usually for the middle class and the lower than the middle class, their source of income is actually just from labor. But those who are rich, the upper class, they actually get rich without lifting a finger because they get their money from capital income. So just like what Robert Kiyosaki says in his book, you make money, you make your money work for you, because most of the time, I'm not exempted also from that, we work for money, right? You do labor. When labor, I'm not talking about just manual labor. When you go to the office, whatever that is, kahit na anong taas ng position mo, if your source of income is just from working, you work for money, because if you stop working, you will no longer have money. All right? So Robert Kiyosaki in his book actually said that you have to make money, work for money. So you get that from capital income. The next video will discuss more about this capital and labor income and how it also arises in the inequality among the rich and the poor.
America is rich. We have a higher income per person than almost any other country in the world, except for a few tiny ones with lots of oil. And we have $71 trillion in household wealth. But where does that income come from? Everyone knows you can get paid for working. Economists call that labor income, and it makes up about 70% of our total national income. But there's also income that comes from merely owning wealth. This is called capital income. Stuff like rent payments, interest on loans, or stock dividends also give you income. Capital income makes up about 30% of the national total, and you don't even have to work for it. Pretty nice. America has a lot of capital income. If you divided up all the wealth in the country equally, each person would have over $220,000 of wealth, which in turn would produce $15,000 of income each year. Wow! But there's a problem. Ownership of wealth is extremely concentrated. In reality, the bottom half of the wealth ladder owns an average of $349, while the top 1% owns an average of over $16 million. That means the bottom half collects an average of $826 in capital income per year, while the top 1% collects an average of over $764,000 per year. That income is also a big portion of the top 1%'s total. While the bottom half gets little or no capital income, almost 60% of the top 1%'s income is capital income. In fact, since the year 2000, all of the income gains of the top 1% have been capital income, and all without having to lift a finger. But wait, there's more. Ownership of wealth is even more concentrated the further you go up the income ladder. The top 0.1% own an average of $83 million in wealth and collect $4 million in capital income each year. Finally, the top 1% of the top 1% own an average of $420 million and rake in $21 million every single year in capital income. So the richer people are, the greater share of their income comes from capital. Fully 3/4 of the top 1% of the top 1%'s income comes from capital. All this makes capital ownership a major engine of inequality. More wealth means more income, which can be used to get more wealth and more income. The rich get richer and everyone else is left in the dust. Inequality is a big problem. If we're going to fix it, we must confront the problem of capital income.
So now that you have already seen the benefits of having capital income, right? So the next video will talk about the streams of income. So an average person has only one source of income, the labor income. So the next video will tell you in what ways you can get more money aside from your labor income.
It is said that the average millionaire has around 7 streams of income. The average person typically only has one, usually from their job, which can put them in a vulnerable position financially. If you take a look at the average millionaire, it is true that they have more than one stream of income generating cash flow. Now, not all types of income are the same. Some are active, some are passive, some are a mix of both, some are highly taxed, and some can be leveraged to not have any taxes at all. So today, we are going over the 7 different types of income that the average millionaire has in their portfolio. If you like videos about business, money, and psychology, make sure to subscribe and hit the bell button to not miss any of our value-packed videos. And let's get started. The first and most common source of income is earned income. This is what you get from a job. This includes the average worker all the way to the CEO. Many CEOs are still employees of a company. Other professionals like doctors or nurses are also included in this category. Earned income is when you exchange time for money, which is what is called active income. This can also include freelancers. Earned income is typically the starting point for many self-made millionaires. This is where the average person starts with, and it's a good way to get started, especially if your job allows you to provide for yourself and your family. But the dangerous part is staying in this category, because this type of income leverages your time, which you have a limited amount of. You only have 24 hours in a day like everyone else, so there is always a ceiling on how much money can be made in this category. This is also one of the highest taxed forms of income. Taxes in this category can go all the way up to 40% of your income, meaning some people in this category pay almost half of their earnings in taxes, depending on their income. This is great as a starting point, but we must know what other types of income are out there. The second stream of income is profit income. This is income produced by selling products or services for more than it costs to make or buy them. This is when we move from employee to entrepreneur. In the past, starting a business required a significant investment to buy or make the products, but it has become much easier in recent years with the help of the internet. Whether you sell a physical product or a digital product, if you sell a product for a higher price than it takes for you to make or buy them, you are making profit income. Now, this can be both active income or passive income depending on your business model. If you make things yourself and sell them, then it's more of an active income and a little more difficult to scale. But if you create the design of the product and you have a manufacturer create it for you, or you make a digital product, it has the potential to become a passive form of income. There are 2 types of profit income: individual or small scale, and business or highly scalable. The individual or small scale is when you either create the product yourself or flip products manually, like on eBay or Facebook Marketplace. And that is a great way to add an additional source to your income. The scalable profit income comes from establishing a business and having a manufacturer, for example, produce your products instead of doing it yourself. This way, you free your time to focus on other aspects of your company, like sales or marketing. Another recent example of highly scalable business is by using digital products. Since they do not require storage, shipping, or even ongoing manufacturing, digital products are extremely scalable. Now, these 2 types of profit income are taxed differently. If you are an individual flipping or creating your own physical products in a small scale, chances are you will be taxed the same as earned income. But if you build a business, you might be able to take advantage of many tax breaks by forming a company or a corporation. The third income category is interest income. You make interest income by collecting interest on money you lended. Now, I don't really mean lending money to your friends. This is typically not a good idea. But there are a few ways to create this form of income. From lending money to the bank in the form of a bank CD, lending money to companies in form of a bond, or lending money to the government in form of treasury bills. These are typically safer ways to invest your money, but are not the most lucrative. Many of these have between a 1 to 4% return rate per year. Now, there might be a few other ways to do it with a little more creativity and higher returns, but a lot more risk. This is a passive form of income because in most cases, your active involvement isn't needed. Number 4, dividend income. Dividend income is when you invest in stocks that pay part of their profits to their shareholders. When you buy a stock in a company, you become a shareholder. Whenever the company that you've invested in reports profits, they will send a check to their shareholders, typically every quarter. As a shareholder, you are part owner of the company, so in companies that distribute dividends, you get a portion of the company's profits. Now, depending on what type of dividend you have, you can pay a lower tax rate with qualified dividends. If you make less than $38,600 in ordinary income, you pay 0% taxes on your dividend income. And it tops off at 20% if you make over $425,000, which is much lower than earned income, which can go up to a 40% tax rate. Number 5, rental income. Rental income typically comes from buying real estate and renting it out to other people. Now, it does not necessarily have to be home rentals. This can also include commercial properties, which is real estate that can be rented to businesses, or industrial real estate, which is rented to manufacturers. Now, rental income does not have to come from real estate specifically. There are other ways to create rental income at a smaller scale. For example, many people rent equipment for various industries, or their cars, or instruments, etc. Rental income is any income produced by lending a property to somebody else in exchange for money. Number 6, residual and royalty income. This type of income is when you continue to get paid after your work is done. Whether you work on a movie that continues to be watched, wrote a book that continues to sell, or more recently, if you built a YouTube channel that continues to be viewed. Royalty income is a form of residual income. Royalty income is money you make by letting other people use your ideas or properties to make money, such as music or books. Music artists, for example, allow streaming services and recording labels to produce and sell their property to the public, therefore making royalties every time a song is played or sold or when someone buys a record. It's a similar thing when a publishing company prints and distributes a book. As long as people keep buying the book, the author continues making money. Now, there can be multiple royalties collected from the same property. A great example of this is the author J.K. Rowling. She did not only make royalties from her book sales, but also from the adaptation of her books in movies and merchandise based on her characters. Even though it's been 20 years since the first Harry Potter book came out, J.K. Rowling, the author, still collects royalties. As long as people are buying merchandise, renting or streaming the movies, or buying the books, she gets royalty payments because those products are based on her original property. Number 7, capital gains. Capital gains income is when an asset that appreciated in value is sold. The most common ones are real estate and stocks, but there are many other assets. For example, if you bought a real estate property for $180,000 and you sold it for $250,000, you made $70,000 in capital gains income. Same goes if you bought 100 shares of a company at $20 a share and you sold them at $120. You made $10,000 in capital gains. Now, this is different than profit income because you are not buying or making a product and selling it for a profit. Here, you have assets that appreciated in market value. You don't have much control over the value increase. But the great thing about capital gains is that taxes paid on this type of income are much lower than most other forms of income. Capital gains tax range between 15 to 20% depending on the amount earned, and they can go down to 0%, such as in real estate. In many cases, if you use your capital gains you got from a real estate property and you reinvest them back into the market, you might be able to pay no taxes at all. You are able to increase your net worth tax-free. When building our income, most of us know only one or two ways of creating income, but knowing the different types of income and how they are made gives us a better opportunity of adding different sources of income into our life. Question: which source of income sounds the best to you? And which one will you add to your income next? Make sure to leave your answers in the comments below. I always like to see what you have to say. As always, thank you for watching, and I will see you in the next video.